It's great to be back at the Milken Institute and to have such a full room for the discussion on the global overview. It's a pleasure to follow His Excellency Khaldoon al-Mubarak and Michael in that discussion that they had in the building blocks here for the UAE in Abu Dhabi. I had a chance actually a couple of years ago to go see that Baraka plant, which is extraordinary. So you think of a country that sits on about 9% of the global proven oil reserves to make that decision to go heavy into solar and heavy into nuclear to balance out its energy demand and supplies is extraordinary. Now, our task here in the next 45 minutes is to do a global overview. And many of you were in Davos here about a month ago, or less than a month ago, and we looked at the landscape and thought, okay, global growth of 3%, it's not bad, it's not fantastic. But those calculations were made before we had a couple of black swans appear on the horizon. One that's a challenge here in the region, of course, is the tensions between Iran and the United States and some of the other Gulf states that we saw in December that spilled over into early part of 2020. And then this black swan called the coronavirus that's hitting the second largest economy in the world. And I've been doing a lot of the coverage here for CNN over the last 2 to 3 weeks on it. And I was looking back at the numbers. In 2003, when they were dealing with the SARS crisis in China, it was an economy of $1.6 trillion. China is crossing $14 trillion in 2020. So we're a much more interconnected globe today. So a shock in China, and we don't know how long that's going to last, does affect this region. It does affect Europe. It does affect the United States. And every time I've been doing an event as of late, I always think it's very important to check my different sources of news, and one was Reuters this morning, and there was a report coming out of China from a state research house saying that for all of 2020, it could knock down China's growth from 6%, which is the lowest in nearly 3 decades, all the way down to 5%, and that's early days of this virus. So let's get an overview to start with. What are the things we're looking at are the positive things for 2020 and some of the challenges and how it affects your investment horizon. We had the names up here on the board. This is a very well-known group, so I don't waste our time introducing one by one. But I think it'd be great, Waleed, on the tail of what Khaldoon had to say about the diversification strategy in the UAE. He looked at the landscape of the building blocks today. They did not talk about the outlook for 2020. How comfortable here, sitting with what was a sovereign development fund, which is now more an investment fund over the last decade, its transformation. How do you see the year in terms of global growth and how some of these factors are going to play into the plans of Mubadala, but very importantly, the UAE?
Thanks, John. So if we had a perfect prognostication record, then I think everybody here would have, an incredible track record. And some of us do, especially people sitting to my left. But I think, notwithstanding that, we've had a great run over the last 10 or 12 years, right? And so everybody's been looking over their shoulders, if you will. When's it going to end? Is there anything that's going to take us to either a kind of slight, wide-shaped recession or correction? Are we in for a V-shaped type of people have been debating that for 2 or 3 years. But the truth of the matter is that facts on the ground tell you that right now, fundamentals are pretty solid. Certainly in the West, right? Really the United States, okay? And so that's what that anchor point looks like. All right, so now let's move east. You talked about the Black Swan event, the coronavirus, what's coming out of Wuhan. Certainly the Chinese economy is going to be affected. Nobody knows how much. So when we invest and when we think about how we're going to deploy capital, we obviously don't think about the short-term, 6 to 12-month cycle. What we tend to do is we like investing through a cycle, right? So from our perspective, when you are at a point where valuations are really high, when you're at a point to potentially seeing some weakness, maybe the Wuhan coronavirus gets much bigger, maybe other geopolitical tensions will cause different things. But when you do that, you revert to some behavior that I think we've been doing over the last year and a half. And let me tell you what some of that is. So for those of you that do what I do, you will know that the first thing that you do is you look at robust cash flow, right? And so that's something that we've been doing, over the last couple of years. If I look at the catalog of the last 20 or 30 new investments that we've done, it's all about making sure that those businesses are able to provide the type of robust cash flow, both in good times and challenge times, right? So I think that's number one. Number two, you always want to try and make sure you don't overpay. But that's tough when valuations are at all-time highs. And it's also tough when interest rates are really low, too, because debt is relatively cheap. And so, you see asset prices going, you see more and more folks going into private equity and alternative assets. So when you see stuff like that happening, you want to make sure that the fundamentals are sound. The third thing you want to do is you want to make sure that you are relatively well diversified geographically speaking. So if you asked me about 9 months ago, I would have said, look at emerging markets. Emerging markets are in for a pretty bull run. Now, especially those emerging markets that are heavily dependent on the commodity cycle, and especially given the unknown impact of what Wuhan is going to do in China, you may see the commodity cycle fizzle a little bit, right? I think they're going to be relatively depressed for the moment. And so what that means is that while I'm still personally bullish on places like Brazil, you have to take it with a little bit of a grain of salt, be a little bit cautious, because at the end of the day, if you do see commodity prices being extremely depressed, you either have to believe that there's going to be some other engine that's going to bring up that economy, or maybe you want to take a pause. I'm in the camp when we talk about emerging markets like Brazil, where we say, I actually believe that because of the new administration that you have under Bolsonaro now in Brazil, you're going to see a lot of infrastructure spending, you're going to see some privatization, you're going to see a lot of new pillars come up that are going to help boost the economy.
Good. Just very quickly, I'd love to get your thoughts here, sitting at the crossroads of East and West. We're seeing a commodity bear market in oil since the start of the year. So we had that peak on the Iran fears of $70 a barrel, and we're struggling to hold on to $53, $54 a barrel. Is this a crack that's quite severe because of the demand of China dropping so rapidly?
Yeah, so I wouldn't call it severe. So I do think that commodities are going to be impacted. You're seeing that. You see that in aluminum, you see that in iron ore, you see that in oil, and so that's absolutely a function of what you're seeing all around the world. But I think what's more important than where you are in the commodity cycle is what you believe is going to happen as a result of kind of supply chain changes that are coming as a result of industry either moving or being reallocated out of China. And so nobody knows how that's going to play out. But you are starting to see manufacturing businesses starting to shift supply chains. And so we don't know how quickly that's going to happen, and we don't know how sticky that's going to be. But clearly, that's going to have an impact going forward.
Good. I don't want to spend the whole time that we have together, but Ray, a man of your seniority and with the different asset allocations you have to make here, how do you see the coronavirus itself? Because the initial reaction is to go back to 2002 and 2003 and the SARS crisis, and they dealt with it. But this seems to have a very different feel to it and the ability to spread, and it's kind of hidden and then pops up. What is the biggest challenge, do you think, here when China is much weaker than it was in 2003?
I'm not a real expert on the coronavirus, so I think I'd almost be the wrong person to ask. In terms, obviously, it's a big one-time shock. How big it becomes, I can't say. We all have our thoughts and opinions. Probably it's contained. Probably it passes, I assume. And then in terms of the pricing of assets, I think it's probably had a bit of an exaggerated effect on the pricing of assets because of the temporary nature of that. So I would expect more of a rebound. I think it most likely will be something that in another year or two will be well beyond and we won't be talking about. I think the big issues, you were asking about the big issues. I think the three big issues are in a dollar-based world monetary system, what will monetary policy be like, what we credit? I think the issue of the wealth and political gaps are an important issue. And I think then the emergence of China and what that means in terms of competitive landscape, that's a big issue and how they'll play out. And then I think also technology will be a very big issue and, of course, climate and environmental issues. Each one will interact. I think if we take the impetuses of the economy, they're largely behind us. They'll dissipate. We've had rate cuts. Since 2008, we've had rate cuts, a lot of central banks printing out money, buying financial assets, that will be diminishing. We're in a position where you're not going to get a benefit of tax cuts, corporate tax cuts. So as we look ahead, I think there's a dissipating of that energy, but that doesn't mean a debt rollover problem. So I think that you'll find a much slower growth. I think the IMF estimate is good estimates. I think it will have larger deficits by a large amount, and that'll mean that there has to be a certain amount of sales of bonds. It'll be larger than there is a demand for. So I think that that'll require the monetization of debt. What concerns me most is if you did have a downturn, and the downturn, we're now 11 years into the expansion, whether it's 1, 2, or 3 years forward, with the larger polarity that it exists, the wealth gap and the political gap, I would be more concerned about that. I think after the turn of the year, we'll also see more of the issues between the U.S. and China play a role.
Good.
So I think those are the main issues.
Yeah, but that point that I was making before, that China at 6% of the projection is now suggesting 5% this year. Because of its scale, does it drag down the rest of the world? And coming into this 11th year of the cycle, as you're talking about, what tools do we have to respond if interest rates have been low and we've had all that monetary easing from the U.S. Federal Reserve, the European Central Bank, the Bank of China? Are we equipped for the downturn?
I think that there's that type of shock. Monetary policy is coming to the end of its effectiveness. That's a big deal because demand has been credit. You know, when an economy turns down, you hit it with credit and it picks up. There's a cycle there, and we're pressing against the limits of that because as you go to zero interest rates across Europe, zero interest rates in Japan, and then very low interest rates in the United States where there's then less room, and then there's printing of money. I think that that will be an issue, and it's going to require, if you're going to stimulate, it's going to require larger fiscal spending, which is difficult to coordinate with, but with monetary policy monetizing it. So you're coming to the end, I think, of a long-term debt cycle, and I think that has implications into, you know, how much negative interest rates do you expect, and how long will they be held, and what is a storehold of wealth? These will be bigger questions over the next few years, I think.
Good. And that leads me to Dina's work in this nexus between the private and public sector. We've been following this region for 15 years and looking at the youth unemployment challenge. It's not something that the UAE is wrestling with, of course, but in the broader Middle East and North Africa, it's the highest youth unemployment. It's hovering around 27% and continues to rise because of the very high birth rates. Where can the private sector and the work that you're doing personally on this with Goldman work to bring that down and accelerate the diversification process in the region where we have sovereign funds actually going into some of these poorer states to break that cycle?
Sure. Well, you know, I think what Khaldun said earlier was right on, which is that it isn't just that ESG all of a sudden is an issue. It's really been a trend and something that's really changed from 10 years ago when people talked about it in terms of philanthropic dollars or kind of on the side, not really central to a business strategy. And today, you can't really have a conversation with a public or private leader, and this is not top of mind for them. And I think the reason it's changing so quickly is that large pools of capital, both private and public, are now investing and changing the dynamics around new technologies, policy changes. And I think what you're really seeing is there's two major focus areas, the sustainability issue and inclusive human growth and inclusive economies. When we at Goldman now talk to our clients, it's the first thing that they raise every time. And one of the things that we're able to talk about is the fact that we tried to use our resources to invest thoughtfully in job creation and growth. We're sitting in a region of the world where 75% of the population here is under the age of 30. And yet 50% of that human productivity is underutilized. If you think about just the growing trend of more women joining the workforce and the enormous impact that has on GDP growth and job creation, and frankly, when women increase their income, they take those they take that income and reinvest it into society. So I think especially in this region, the region of my birth, I hope that we're going to see more investors, whether it's public or private dollars, really focused on this inclusive agenda of more women, skills training, and better education, and also, frankly, on the sustainability track, because I think that is really going to drive new jobs in this region and elsewhere.
It's interesting you said that because His Excellency Khaldoon said it in the conversation with Michael. Every single time you sit down with somebody, one of the first things they address is ESG, environment, sustainability, and governance, and human capital development. It's extraordinary how much that's changed and how quickly, but isn't there a risk that after we're into this 11th year of the cycle, that these are the economies that will suffer the most? And we have to take a step back. You know, Syria, Libya, Algeria, Sudan, Lebanon, the protests. I mean, the frustration level is as high, if not higher, than it was in 2011, Dina.
Well, it's extremely high because things aren't changing fast enough for people on the ground. There's also the risk, though, that leaders aren't thoughtful about how quickly these changes happen. So we're all very eager to talk about clean energy and new technologies, but we're not also being honest about just how carbon dependent we are. And so moving too quickly in these areas really hurts the people that you're describing the most. In emerging economies where they are so dependent and trying very hard to get out of that dependency, but also trying to create jobs and growth.
Good. Adam, congratulations on the new role. This is a new entity in the United States that has a very different mandate, which you can explain at the International Development Finance Corporation. At its core, and many would criticize the United States for being on the sidelines for far too long when it comes to Africa and the inroads that China has made there, the partnerships that Russia has been able to establish here in the Middle East, and I'm going to bring Waleed into the conversation as well. This is an administration that's quite willing, along with Congress, with bipartisan support here, to say we cannot leave these countries or continents to be taken by China and Russia with undue influence? Is that at the core mandate?
Yeah, I mean, so first let me identify who we are. You know, we're a $60 billion fund that was established by the U.S. government to invest in development globally in emerging countries. And I'll note, first of all, it's the first time that I feel insecure about my amount of money when I'm in UAE. Everybody's
only 60 billion.
They're like,
serious?
Maybe one day you'll grow up and actually move higher than 60 billion. Everywhere else, everybody's impressed, but here it's low. But our mandate is to drive development globally and to advance foreign policy. We also happen to be one of the only agencies in the United States that makes money for taxpayers. But I think what you said is correct, which is one thing that I've heard, and I was confirmed, and I'll note, I was confirmed unanimously, and it's not because I'm such a great guy, it's because there's bipartisan support for American investment abroad. And I'll compliment Congress in that they recognize that we needed to do something. So every single meeting that I've had with heads of state, I've been to 12 countries since I was just confirmed, everybody says we needed an alternative. We need balance. And a lot of times they'll say, look, we knew what strings were attached with that cheap capital from that autocratic government because nothing's a free ride. But where were you? And I think that's fair. I think it's a fair point. And so what DFC represents is an answer to that, which is here we are. And that is my job, to drive development. And the second thing I'll note, and one reason I'm here, is to identify allies that have shared interests. You talked about Iran. We have a shared interest with UAE and others here in ensuring that there's security in Iraq, for example. And so one of the things I'm looking to do is identify where that is and invest together. And invest together on one platform where we have a voice, where we're saying what needs to be changed in a positive way.
Good. There's a lot we could talk about, and we have about 15 minutes, but I wanted to follow up on this idea that Dina brought up, which is the ESG. I find it because we have a new program on CNN called the Global Energy Challenge, which is looking to transition from hydrocarbons to renewables. You cannot tackle climate change unless you have China and India in the same tent on coal, and they consume 2/3 of the world's coal. Is it part of the mandate of the DFC to say, look, okay, the regional development banks, the EIB in Europe, the World Bank says it's not investing in hydrocarbons. How do we accelerate this process to speed up the transition on the most damaging hydrocarbon, which is which is coal?
Yeah, I think that the United States sometimes suffers from a PR issue, meaning because of the Paris Accord pullout, folks think, well, the administration of the United States doesn't care about clean energy. Right now, 90+% of our investments are in renewable energy. And so I think what we need to do is hold those to task that say they're leaders in renewable energy. Are they? Here in this country, we just heard about the focus both with nuclear and investment in renewable. And you mentioned China, India. I think we need to hold folks accountable. And what's not important is what they say. What's important is what they do. And I think we have to look at the facts of what people do and hold them accountable to that. And I think that will be very important. Good.
Now I'm going to go back on the geopolitical levels because it's something Ray wanted to address, and I would like to have Waleed get involved here. There's been within Mubadala, Waleed, a geopolitical, geostrategic rebalancing because ADIA, for example, the investment authority, had so much exposure to the United States and Europe. We've seen over the last decade investments and partnerships with Russia and in China and in India most recently, very strategic ways that the UAE has gone on the Silk Road and said, okay, we can partner with you. How do you describe that to somebody like Adam that thinks that Russia and China have too much influence, or is it at the crossroads of East and West, very wise for you to have that balance in your portfolio? Please.
Great question. So as an investment entity, we look for return. We look for opportunity. And at the end of the day, when you trace how our portfolio evolves, you called it a rebalancing. Certainly, it's because we see opportunity in places like Russia and China. It doesn't mean we don't see opportunity in the United States. It doesn't mean we don't see opportunity in Europe. Certainly, the great majority of our portfolio is still located in the United States and in Europe. But when you have great partnerships, when you have folks who have the same values that you do, and when you're able to identify those sectors that are interesting and that will make you the type of return from a risk-adjusted perspective that justifies that deployment of capital, like we did in Russia and China, then clearly there's an argument. So let me give you a couple of examples. So we've been in Russia now for 8 years. We went in when everybody was coming out. There was a mass exodus of foreign investors in Russia when we went in. And at the end of the day, we took a cold, rational look at those sectors that we think were interesting. We have large infrastructure positions in Russia. We have large energy positions in Russia. We took a few public market positions. And today, fast forward, we have 45 different positions in Russia. We are making double-digit returns in USD. They are cash generative. And it's one of the highlights of our overall portfolio.
Can I interrupt you for a second?
Sure.
That's a great point you make, because I saw the work you've done with the Direct Investment Fund of Russia,
Yeah.
RDIF. How much is that political, and how much of it is really the bottom line for Mubadala?
Real simple. None of it's political. It's all about the bottom line. Now, at the same time, you understand that this builds on the great relationships that we have with China and Russia. But when you make an investment decision, it's entirely an investment decision.
Okay, good. You square with that, Adam. You're all right with the language of an ally like that, balancing their portfolio?
So foreign policy is a focus of DFC. And so let me outline a little bit how we play into the foreign policy of the United States. And also, I'll talk about China. So at the end of the day, I think DFC plays a very important role in economic diplomacy. So the United States is very good at the negative. We've got a great army. We're really good at sanctions. But we haven't always had the positive tool from an economic perspective, and that's where I see the pull and people asking. The other question I get asked a lot is, well, is DFC a response of the United States to China, to BRI? And my answer there is yes and no. At the end of the day, we play in the United States our game, right? So you're playing offense. Now, if you're playing a good offensive game, you know what other people are doing. So I pay attention to what China or other autocratic governments do, but I don't plan my game or our plays based on it. I play our game. And the most important thing, I think, about the foreign policy of the United States, and I think it's a really important nuance, is that what we want at the end of the day is open, free, transparent markets that are based on rule of law. And our fear or our concern about an autocratic government is undue influence in a sovereign nation. And that's where the balance is important. So our goal isn't undue American influence. Our goal is for that sovereign country to be making the decisions and not to be pressured by any one country. And so that's how our investment philosophy is. So I think this concept of balance is important. I think this concept, I think the United States is very interested in backing their friends and their allies. Every once in a while, you know, it's like when you go to a restaurant, the person that complains the most gets the most attention. This is a chance for us to back our friends and our allies and people that have been with us. So those are our goals politically.
Good. Love to give Ray's views on China, because you said the world order is changing, and then I want to circle back with Waleed and Dina on hydrocarbons here and the influence it could have on the region and transition. But it's great to get your thoughts on what has happened over the last 18 months. The challenge on China with trade, almost like the bully on the block, sanctions, sanctions, sanctions. And this is a delicate window for China right now. But how is the world order changing in your view, and what needs to be done, listening to what Adam had to say, Ray?
Well, the world order is changing because you're having the emergence of a great power to challenge and compete with an existing world power in a number of dimensions. And so there's a trade war, there's a technology war or a competition, there's a geopolitical conflict, and there could be a capital conflict. So it's a classic situation of that rising power challenging the existing power and competing and going global. This has happened through history. You know, the existing world order began, think about it, 1944. 1944, U.S. dollar becomes the world's reserve currency. The end of a war, the United States is the dominant power. After a war, nobody wants to challenge the dominant power. You have a period of peace. And then we also begin a debt cycle. And so we're later in all of those cycles, and this is the emergence. This has happened over and over through history. The arc of the British Empire replacing the Dutch Empire, and so on and so forth.
So you're
I think it's a
suggesting
big,
the Chinese replace
issue.
them, Ray?
And well, I think you have to view it as there are two big competitors. And so if you were to think about technology or the industries of the future, I think you have to diversify and be impressed by all that's been accomplished in China. And so, yeah, I think that's the new world order.
Good. Let me follow up very quickly. Is the coronavirus, so, an indication of why this very powerful leadership probably didn't get the information from some of the provinces and it was squashed? And this is the downside of having such a powerful leader like President Xi.
I don't think so. The capacity to gather information in China is unparalleled anywhere else in the world. So there's fabulous information gathering. Now, what goes on inside, I can't say. But if I was to take the statistics, the average life expectancy in China since I was going there over the last 35 years has increased by 10 years, life expectancy. The average income has increased by 26 times. Share of world GDP has gone from 2% to 22%. And so there have just been so many general levels of improvement, openness of the financial markets, almost a capitalist environment in terms of people can become rich with new ideas. All of that has been the environment. I would say you have to look at all of those factors over that period of time. You're dealing with a different system, of course. You're dealing with a more top-down, more autocratic, less bottom-up, and there'll be debates about the relative merits of those things. But the overall effectiveness, and then, I would say the individual intelligence and wisdom. I think it's valuable to see China in longer-term history. If you take the last 1,000 years, it's always been like one of the most powerful countries in the world up until around 1800 for various reasons. So no, I think there's and to not include it as a competitor, would be naive. So now both countries have to take care of themselves, do the best they can. There's competition, and so where you invest or where you are, it's going to be competitive is the main thing.
Good. Go ahead, Dina. You
John,
want
I was just going to say I would add a fourth movement to Ray's first three, which is the rise of populism. The rise of populism in North America, the rise of populism as a movement in Europe, and certainly in Latin America as well. And I think it's something that, frankly, government leaders haven't, answered the call in many of these situations. It's why you're seeing people ask about youth employment year after year here in this region. I think people are really tired about talking about women's empowerment as a source for economic growth, but not really seeing much movement on that. Tired of seeing a lack of job creation for the middle class. And I think that, honestly, government is failing to some extent. People certainly see it that way. And I think that's why what Khaldoon was talking about earlier and Waleed, sovereign wealth funds, private sector, business leaders are starting to say, we've got to really step in here and work with the government where we can. We've certainly worked with Adam on a number of initiatives. But I think that not putting that central as one of the major movements that is what is going on around the world is very dangerous, especially in a downturn. And I think people are, tired. We used to talk about the issue of women's empowerment for many, many years as a justice issue or a human rights issue. It's just smart economics, and it's time for business leaders to act on it.
and to accelerate that process. I wanted to follow up with you on this International Monetary Fund report that came out recently, since the start of the year, saying there's basically a 15-year window for even the Gulf states who sit on natural resources to make sure they diversify the economy, as we are seeing here in the UAE, or go bust. And on the very issue you're talking about here in the broader region and having the sovereign funds transfer funds into some of the poorer states, this is quite a critical window to get it right. What's the Goldman's view on this? And a pretty provocative report that was put out there, and then I'll finish with Waleed.
Sure. Well, obviously, Waleed will know this much more than I do. I think it's honestly one of the reasons we've been working with our clients here in the region. We recently worked, for example, on the Aramco IPO, and one of the selling points, really, to investors is that they have been for many years diversifying, looking at new energy technology, and it's something now that it's going to really be, focused on in any of the in the broader energy sector. But I think the UAE is an excellent example. I think what they're doing here is something to to really follow and to look at. I would be curious, though, Waleed, what you would say to the IMF report, because I think it is, especially again in a downturn, a really sensitive issue.
It is a sensitive one. In fact, before we posed that, I went back to 2015 to look at the quote from His Highness Mohammed bin Zayed at the World Government Summit, and you were there, I think, Waleed, if I'm not mistaken. This is a quote from him then, saying, in 50 years, when we might have the last barrel of oil, the question is, when it is shipped abroad, will we be sad, he asked. If we are investing today in the right sectors, I can tell you we will celebrate at that moment. So he's forecasting up to 2065, which makes a lot of sense because of the low-cost producers here. Is this part of the mandate for Mubadala? And when you saw that report, I would imagine with about $1.3 trillion of sovereign wealth in the UAE, there's no panic. But what did it tell you about the urgency, to Dina's point here, to move fast?
So what it tells you is that what we've been doing for the last 15 years as Mubadala and the last 45 years as the UAE is the right thing to do. You're given a base, the hydrocarbon wealth that we started with. That wealth, because of great leadership, was translated into world-class infrastructure, which everybody is seeing today, great education, good healthcare. But at the end of the day, everybody recognizes that that's not enough. Because if you want to maintain relevance as an economic actor, if you want to ensure the best quality of life for your citizens, for the folks who live in one of the most open economies in this part of the world, you need to make sure that you keep growing. And the way to keep growing is to make sure that your economy is innovation-led. You want to make sure that technology, not just as a consumer, but as a developer and exporter eventually of that, is something that drives your economy, and that you're continually looking for ways to address some of the big issues of the day. So when somebody mentioned that we have one of the youngest populations on Earth, while we don't necessarily have an employment problem today, it's really important that we think about how we absorb all those young folks and make sure that they have productive ways to contribute to the overall well-being of society. So that quest to economic diversification and the bridge that hydrocarbons have given us is something that we're continually looking at and will be important for us for the next 20, 30, 40 years.
Good. Do you think that 15-year time horizon for the Gulf states by the IMF is too aggressive in 30 seconds?
So whether it's 15 or 20 or 10 or whatever the number is, at the end of the day, it's an important call to action. Everybody in the GCC is thinking about diversifying. Not everybody is at the same level of diversification. And so all it means is keep going.
Great. A good place to finish. A fantastic panel. Thanks very much. Waleed, Ray, Dina, and Adam. Thanks a lot. Nice round of applause for them. Thanks for them.